Leading the Dow today was Home Depot, while Nike was the biggest decliner. On the S&P 500, Advanced Micro Devices, biggest winner again. Boy, what a ride. Strong stock that is. Seagate was the biggest laggard today. So, Mike, historically, September is the worst month of the year for stocks, and it started off a little bit soft.
Yeah, I mean, mild softness. Actually, if you looked at the pre-market, it was when Europe opened that the weakness started, and after Europe closed, the U.S. market kind of firmed up. You don't necessarily want to point the finger directly at that, but it seems as if that was the concern. Of course, the emerging markets still under a little bit of stress, but the U.S. really not finding a lot directly to worry about. So it seems like nothing has really disturbed the general trend. We've held very close to the recent highs. I feel like it wouldn't be surprising to pull back a few more percent here and still not have that overall story of general strength be changed too much.
Phil, when you see that stark performance difference with Europe, is that something that encourages you to put more money to work in the US, or makes you think there's got to be, if not a pullback in the US, a catch-up from Europe?
Remember, the breadth of the market's still been pretty narrow. So while I like European valuations, they're really cheap, 25% off historicals. It's hard right now when the dollar's this strong. So unfortunately, you got to kind of pick your poison here. The dynamics of the U.S. market are strong. To Mike's point, you got low inflation, relatively, you still got relatively low interest rates. You're below the real rate. So you got to look at this opportunity to pick your spots. But remember, September's a tough month, so maybe hold a little cash, get through the waves of volatility that should come with the election cycle, and look for an opportunity on the other side.
You see waves of volatility with the election cycle?
I do. You know, there's going to be a lot of rhetoric around the House and the Senate. Early estimations are like that could be the House might be up for grabs, and the Senate's a little bit of an unknown. Mix in a new candidate for the Supreme Court and the rhetoric coming out about China and Canada all together at the same time. Create this. Do I manage the headline or do I manage earnings? Earnings, listen, take away the tax stimulus, you're still 16% or better top line earnings with revenue and sales at around 9. Those are things that tell you to buy this market, but unfortunately the headlines are tough, especially with Europe and emerging markets.
Kari, Credit Suisse said earlier on the show that they expect to see the S&P at 3350, about 15% higher by December next year. What would you say to that?
I'd say from their lips. You know, who knows? I think that's a bold call. We know that earnings have been strong, and this is a market that is trading on earnings. It's trading on a flight from overseas into the U.S. It's on consumer sentiment. And I think that the competition from interest-bearing vehicles such as bonds just isn't there right now. So as long as we keep this trend in place and earnings can grow, I think it's hard to fight that market, and money on the sidelines is getting tired of being there. So we've seen that since the beginning of July, that money has moved into the market in a way that surprised many people, and now they're clamoring to get on board. As we all know, things can change. The market can get expensive. If it goes up another 7 or 8%, we're really in, I would say, heady territory in terms of the PE ratio, and investors may become worried at that.
I'm wondering, Mike, what 10-year treasuries have to do with all this. I mean, 290, we saw it tick up. We got really strong ISM manufacturing numbers today, almost the best ever.
Yeah.
And I wonder if we cross that 3% threshold again, that could act as some sort of headwind to stocks.
It could, yes. I mean, to Kari's point, you don't have a lot of room to play with in terms of relative stock bond valuations if yields go higher, and corporate yields obviously track with treasuries the way you would expect. So I do think that's one element. I don't think that's outright bad news. It's just one of those offsets that you get to a bullish equity market. The other thing with this very strong ISM number that you mentioned is the market still has that sensitivity to the possibility that we're looking at peaky numbers right here, that there is been a bit of a front loading of activity, because otherwise you would have, I think,
loading ahead of trade tariffs?
Well, that exactly, but also just the fact that we have all these incentives with the tax package to invest in capital spending and things like that. So maybe you're seeing this little bit of a rush of activity that's going to fall away. I don't think it's going to fall apart from there. I mean, usually you don't go from above 60 ISM to skirting recession risk very quickly at all. But it shows you that this market thinks after this year you're going to have to navigate a little bit of a deceleration.